On May 15, 2026, a 13F filing was quietly uploaded to the SEC's EDGAR database. 23 pages, 70 holdings, total value $3.38 billion. The filer was a hedge fund manager named Stanley Druckenmiller, and the document recorded what he had done with his money during the first 3 months of the year. Most people will never read it. The financial press gave it a few paragraphs. The headlines focused on one detail, that he had exited his entire position in Alphabet, the parent company of Google. A few mentioned that he had slashed his Amazon holdings from 737,000 shares down to 9,539. Almost no one connected the rest of the dots. Here are the dots. 2 days before that filing was uploaded, on May 13, 2026, the United States Senate voted 54-45 to confirm Kevin Warsh as the new chairman of the Federal Reserve, the closest confirmation vote for a Fed chair in the modern era. Warsh took the oath 2 days later, on the same Friday that 13F was filed. Kevin Warsh, after leaving the Federal Reserve in 2011, spent the next 14 years working as a managing director at Duquesne family office, Stanley Druckenmiller's office. He sat in those rooms, he read those filings, he helped construct that portfolio. The current Treasury Secretary of the United States, Scott Bessent, was personally recruited by Druckenmiller into the Soros Quantum Fund in 1991. The two of them stood side by side on September 16, 1992, Black Wednesday, when the Bank of England burned $27 billion in a single day trying to defend the British pound, and lost. The trade that broke them was placed by Druckenmiller and executed with Bessent. 34 years later, the man who pulled the trigger that day has one student running the Treasury and another running the Fed. He holds no office. He has no vote. He doesn't need either. And the 13F filed last Friday tells you what he is doing with his own money while his students prepare to run American monetary and fiscal policy. This is not a conspiracy theory. The Senate vote is on the record. The 13F is on the SEC website. The Financial Times has reported on the relationships in detail. Druckenmiller himself, the day Warsh was nominated, gave a quote to the FT that everyone should read twice. He said he was very excited about the cooperation between Warsh and Bessent. What I want to do in this video is explain what this configuration actually means for the price of gold over the next 12 to 18 months. Because the framework you have been using to price gold, the one that watches CPI prints, dot plots, FOMC press conferences, that framework is now obsolete. Not wrong, obsolete. The variables that mattered last year are no longer the variables that matter now. This is not financial advice. This is how I am thinking about the next 12 to 18 months. Take what is useful, leave what is not. The first thing to understand is who Stanley Druckenmiller actually is. Not the headline version, the real version. For 30 years in the world of global macro trading, this man has been treated the way physicists treat Einstein. He ran the Quantum Fund for George Soros for 12 years as chief portfolio manager. The 1992 short on the pound, the trade that bankrupted the Bank of England and put Soros's name in every history book, was Druckenmiller's idea, sized by Druckenmiller, executed by Druckenmiller. Soros approved it. Druckenmiller built it. He left Quantum in 2000 and ran his own hedge fund, Duquesne Capital, for another decade. He posted 30 consecutive years of positive returns. He averaged roughly 30% annual gains. He never had a down year. Read that sentence again, because in a profession where most managers blow up within a decade, what Druckenmiller did is mathematically obscene. In 2010, he converted Duquesne into a family office, returned outside investor capital, and started managing only his own money, a few $1 billion of it. That is the structure that filed the 13F last Friday. One investor who worked at Duquesne described what it was like to be around him this way. Being in Druckenmiller's presence, he said, was the equivalent of taking a complete course in macro investing. People who study under him do not pick up techniques, they absorb a worldview. That worldview can be summarized in 2 sentences, and Druckenmiller has been saying them publicly for over a decade. Sentence 1. The American fiscal deficit is a time bomb. The federal government has been spending money it does not have on a scale that has no historical precedent during peacetime. Sentence 2. Quantitative easing, the program the Federal Reserve started in 2008 and ran on and off for 15 years, was a catastrophe. It created an economy where asset prices went vertical while wages stagnated. People who owned stocks got rich. People who didn't got crushed. The Fed didn't just make a mistake. The Fed manufactured the largest wealth gap in modern American history. The historical figure Druckenmiller has cited as his hero, in interview after interview, is Paul Volcker, the Fed chairman who, in the early 1980s, raised the federal funds rate above 20% to break the back of double-digit inflation. Volcker's approach was simple, brutal, and effective. He destroyed inflation by destroying demand. He did not care about being popular. He cared about credibility. That is the man Druckenmiller admires. That is the philosophy he has transmitted, over 14 years of daily contact, to the man now sitting in Powell's old chair. Kevin Warsh's confirmation hearing was on April 21, 2026. If you watch the recording, you can hear Druckenmiller's voice coming out of Warsh's mouth. Warsh told the Senate Banking Committee that the Fed's balance sheet, which grew from under $1 trillion in 2006 to roughly $6.5 trillion by early 2026, is, in his words, one of the primary causes of American wealth inequality. He used the phrase regime change to describe what the Federal Reserve needs. He has used that phrase publicly before in a CNBC interview last year, and it is not casual language. Regime change does not mean a tweak. It means a teardown. What does the teardown look like in practice? Warsh has been specific. He wants to shrink the balance sheet aggressively. He wants to cut the number of FOMC meetings from 8 per year down to 4. He wants to eliminate the post-meeting press conferences. He wants to kill the dot plot, the chart that shows where each Fed official thinks rates should be, which he believes gives markets a false sense that the Fed knows the future. JP Morgan's rates strategy team confirmed in a research note last month that every single one of those changes sits inside the chairman's discretionary authority. Warsh does not need a vote. He does not need Congress. He can do all of it. The implication for anyone holding gold is direct, and most people are still missing it. Gold is priced, fundamentally, against one thing: the credibility of fiat currency. When central banks print, gold rises. When central banks credibly stop printing, gold stalls. Over the last 15 years, gold has gone from roughly $1,000 per ounce to where it is trading now in the mid-4,000 range. The single biggest driver of that move was the Federal Reserve's willingness to expand its balance sheet without limit. Each round of QE diluted the dollar. Each dilution made gold worth more in dollar terms. The relationship is not theory. It is the chart. Warsh, if he succeeds in shrinking the balance sheet, if he actually walks the talk on regime change, is doing the opposite of QE. He is destroying dollars instead of creating them. In the language of monetary credibility, he is rebuilding the franchise. Warsh said something a few years ago, in a speech that most people did not pay attention to at the time, that you should hear in full. He said the price of gold is the report card of the Federal Reserve. When gold rises, it means the Fed has failed. The currency is losing value. The institution has lost its grip on monetary discipline. When gold falls, it means the Fed has succeeded. Now stop and think about what it means that the man who said those words is now grading his own report card. He is, at minimum, motivated to suppress the price of gold. Not because he hates the metal, because a falling gold price is, by his own definition, the scorecard of his job performance. If you are an investor sitting on a gold position, you should understand that there is now, for the first time in 15 years, a Federal Reserve chairman who would consider it a personal victory to see your asset drop in value. Intent is one thing, reality is another, and the reality Warsh inherited is the reason this story doesn't end where most analyses stop. Warsh wants to shrink the balance sheet. He wants to suppress gold. He wants to restore the Fed's credibility. These are his preferences. Now look at what is sitting on his desk on his first day in the chair. Brent crude is trading at $112 per barrel as I record this. The Strait of Hormuz, the narrow waterway through which roughly 20% of global oil moves on any given day, is effectively closed. Iran and the United States are in a shooting conflict that the administration is still calling limited, a word governments use right up until the moment it isn't. Trump publicly called off a planned strike on Iran earlier this week after the leaders of Saudi Arabia, Qatar, and the UAE personally asked him to hold off. That is the level of geopolitical fragility we are operating in. The Consumer Price Index for April came in at 0.6% month over month. The March reading was 0.9%. Annualize those numbers and you are looking at headline inflation running somewhere between 7 and 10% on a current momentum basis. The Fed's 2% target is not in the same zip code. The CME FedWatch tool, which tracks market-implied probabilities for Fed action, currently assigns a 97% probability that rates will remain unchanged at Warsh's first FOMC meeting on June 16th and 17th. Bank of America's interest rate strategy team has pushed their forecast for the first rate cut all the way out to the second half of 2027. This is the box Warsh just walked into. He wants to shrink the balance sheet. To shrink the balance sheet, the Fed has to actively remove liquidity from the system, either by letting maturing bonds roll off without reinvestment or by selling assets outright. You cannot do that during a period of accelerating inflation without triggering a market dislocation. Fitch Ratings published a note last month warning explicitly that aggressive balance sheet reduction in the current environment carries systemic risk. Translation: if Warsh tries it, something breaks. A bank, a hedge fund, a pension, something. At the same time, Trump is publicly demanding rate cuts, loudly, daily. Warsh cannot cut because inflation is too hot. He cannot tighten because the cost of capital is already strangling the economy. He cannot do nothing without disappointing the president who appointed him. This is a trap, and Warsh, who is not a stupid man, walked into it with his eyes open, which raises the obvious question: why? The answer is that the entire intellectual case for what Warsh wants to do depends on one specific story being true. He told the Senate Banking Committee, in plain English, what the story is. He said that artificial intelligence is producing a productivity revolution that will compress costs across the economy. He said that this compression will allow the Federal Reserve to cut interest rates without triggering an inflation rebound, because the deflationary impact of AI will offset the stimulative impact of lower rates. Read that argument carefully. It is sophisticated. It gives Trump exactly what Trump wants: lower interest rates, but it packages the policy inside an academically respectable wrapper. Warsh does not have to say, "I am cutting rates because the president told me to." He can say, "I am cutting rates because the productivity equation has changed." It is, intellectually, a very elegant maneuver. It also has one fatal weakness. It requires the AI productivity narrative to remain unbroken. 8 days ago, on May 13th, the same day Warsh was confirmed, NVIDIA's CEO Jensen Huang boarded Air Force One in Alaska during a refueling stop and flew with President Trump to Beijing. Tim Cook was on the plane. Elon Musk was on the plane. They were going to negotiate one specific outcome: reopening the Chinese market to NVIDIA's H200 AI chips, which had been blocked by the Trump administration's own export restrictions since 2025. Here is the configuration. NVIDIA's most recent earnings guidance explicitly excluded any China data center revenue, zero. The CFO, Colette Kress, told analysts on the previous earnings call that the company does not know whether any imports will be allowed into China. The Trump administration approved H200 sales to China in December of 2025 with one condition: the U.S. government would receive 25% of the resulting revenue. Since that approval, not a single H200 chip has been shipped to China. Beijing has quietly instructed Chinese companies to wait. On the same day Huang was on the plane to Beijing, a short seller called Cooper Research published a 40-page report alleging that NVIDIA's China revenue is not actually zero. They claim, with shipping records and transaction data, that more than 20% of NVIDIA's compute revenue is still flowing in from China through intermediaries in Singapore and Malaysia. They allege that the largest of these intermediaries, a company called Max Speed, saw its assets grow from $30 million to $3 billion in 12 months, with $29 billion of unexplained refundable deposits, and that the entity is secretly backed by Alibaba. Yesterday, May 20th, NVIDIA reported earnings for the first quarter of fiscal 2027. Revenue beat consensus by approximately $1.9 billion. Earnings per share came in above estimates. By the headline number, it was a beat. By the number that actually matters, forward guidance for the China re-entry path, the report was vague. Management acknowledged the Beijing visit. They did not provide a delivery timeline. They did not provide a revenue framework. They did not contradict the Cooper allegations, and they did not address them directly. The stock's after-hours move was tepid, considering the magnitude of the headline beat. The market is starting to ask a question it was not asking 30 days ago. What if a meaningful portion of NVIDIA's growth story is being held together by a Chinese channel that officially does not exist? What if the productivity revolution that Warsh's entire monetary framework depends on is, at least in part, an accounting story? Austan Goolsbee, the president of the Chicago Fed, gave a speech at Hoover Institution last week that directly contradicted Warsh's AI thesis. Goolsbee's argument, which mirrors what former Treasury Secretary Yellen has been saying for over a year, is that AI is genuinely improving productivity in some sectors, but the path to that productivity runs through enormous capital expenditure. Microsoft, Amazon, Alphabet, and Meta have collectively committed over $500 billion in AI infrastructure spending through 2027. That money is flowing into construction, into electrical grid expansion, into water cooling systems, into rare earths, into the entire supply chain of building data centers at industrial scale. Every dollar of it is inflationary. The deflationary payoff, if it arrives years later. The inflationary cost is now. This puts Warsh in a genuinely paradoxical position. If the AI narrative stays strong, if NVIDIA continues to print blowout quarters and the hyperscalers keep accelerating capex, then markets do not need rate cuts because the AI trade is already providing all the liquidity equities need. Cutting in that environment would simply pour more fuel on an already overheated rally. Warsh would be cutting into a bubble. If the AI narrative cracks, if Cooper's allegations are validated, or if the Beijing negotiations collapse, or if NVIDIA's next guidance disappoints, then the entire intellectual scaffolding for Warsh's productivity allows cuts argument falls apart. He cannot cite an AI productivity dividend that the market has stopped believing in. Either outcome is bad for Warsh. One says he doesn't need to cut, the other says he can't justify cutting. For gold, the implications run in the opposite direction. The longer Warsh is forced to hold rates steady against Trump's pressure, the more pressure builds in the political system. The more pressure builds in the political system, the higher the probability that when cuts finally arrive, they arrive aggressively. And aggressive late cuts, against a backdrop of 7 to 10% annualized headline inflation, is a textbook setup for the next major leg up in gold. Not next month, but the trajectory is being written now. There is one more piece of this configuration that almost no one has noticed, and it is the piece that tells you Warsh is being protected by people who understand the game he is playing. Jerome Powell did not leave the Federal Reserve. Under any historical precedent, when a Fed chair's term ends, that person packs up and goes, back to the private sector, back to academia, back to a board seat at Goldman Sachs. The chairman's chair empties, the chairman exits the building, and the institution moves on. The last time a former Fed chair stayed on as a sitting board governor after his term ended was 1948. Mariner Eccles, almost 80 years ago. Powell decided to stay. His governor term runs until 2028. He has publicly stated he will remain on the board at least until the Justice Department investigation into Fed renovations, the one Trump's DOJ launched and then quietly dropped last month, is fully concluded. On the surface, this is presented as Powell standing guard over the Fed's institutional independence. That framing is true as far as it goes, but it is incomplete. The complete framing is this. Powell staying at the Fed is a strategic gift to Kevin Warsh, and Druckenmiller's school of thinking would recognize it instantly. Trump wants rate cuts. The FOMC, as constituted, will not deliver rate cuts in June. Trump will explode publicly. He always does. And when he does, who does he attack? Almost certainly Powell, because Powell is the target Trump has been attacking for 8 years. The muscle memory is built in. Within hours of Warsh's confirmation, Trump posted that Powell was only staying at the Fed because he could not find another job. The attack instinct fired immediately, and it fired at the old target, not the new one. Every minute Trump spends attacking Powell is a minute he is not spending attacking Warsh. Powell is, in trading terms, a sacrificial bid. He absorbs the pressure that would otherwise destroy the new chair's credibility before he has had a chance to build any. And that is not all Powell's continued presence accomplishes. It also forces a chair reshuffle within the Board of Governors. Stephen Miran, the governor Trump installed in 2025, had been occupying the board seat that has now been reassigned to Warsh as chair. Miran has to move. Or in some configurations, depending on how the seats get reorganized, Miran is being effectively sidelined. This matters because Stephen Miran was the most aggressive dove on the entire FOMC. He voted in favor of rate cuts 6 consecutive meetings. He was Trump's loudest internal advocate for emergency easing. He was also, paradoxically, a liability. Every Miran dissent in favor of cuts made the rest of the FOMC look more hawkish by contrast, and gave the bond market a reason to question Fed unity. With Miran's voice neutralized in the rotation, the most embarrassing internal pressure point for the new chair quietly disappears. Then look at the other members of the committee Warsh is inheriting. At the April meeting, 3 Reserve Bank presidents, Hammack of Cleveland, Kashkari of Minneapolis, and Logan of Dallas, dissented in the opposite direction. They did not vote in favor of cuts. They voted to remove any language from the statement that even hinted at the possibility of future cuts. They were arguing that the discussion of cutting should not even be on the table at this point. That is, 3 sitting voters who structurally oppose easing, plus Powell continuing to hold a vote on the FOMC, plus a new chair who privately wants to tighten via balance sheet reduction. Adding up the voting math, Warsh has at least 4 to 5 committee members who will vote against any cut Trump pressures him to deliver. Warsh himself only holds 1 vote. The strategist at Natixis described Warsh as potentially the least influential Fed chair in modern history. That description is meant as an insult. From Druckenmiller's perspective, it is not an insult, it is the entire point. Druckenmiller has said repeatedly in his lectures and his interviews that one of the most important rules in macro trading is to use volatility rather than be used by it. The corollary, for someone running an institution, is let your opposition do the work that your office cannot do publicly. Warsh does not have to be the bad guy holding rates steady against the president. The FOMC majority will hold rates steady, and Warsh can publicly express regret while quietly delivering exactly the outcome he wants. He can even tell Trump with a straight face, "I tried, they wouldn't go along." This is what playing the institution looks like when you have been trained by someone who has been beating institutions for 30 years. If you accept the configuration I have just described, a chairman who privately wants to tighten, a committee that structurally cannot ease, a president who will demand cuts that are not coming, an AI narrative that is starting to wobble, an inflation backdrop that has no off-ramp, and a hedge fund philosopher in the background who has been positioning his own portfolio for over a year, then the trading question is no longer, what happens at the next meeting? The trading question is, when does this configuration resolve, and into what? My judgment is that the resolution comes in the 3rd quarter of 2026, not because anything magical happens on July 1st, because 3 independent variables will by then have moved from question marks into knowns. And when 3 variables resolve at the same time, in a market that has been paralyzed waiting for clarity, the price reaction is not a drift, it is a discontinuity. Variable 1. Warsh will have chaired 1, possibly 2 FOMC meetings. The June meeting is almost certain to hold rates steady. The July meeting, assuming the standard cadence holds before any of his structural reforms are implemented, will give the market its 2nd data point. 2 meetings is enough for the market to triangulate the man's actual reaction function, how he responds to pressure, how he handles dissents, what language he uses to describe the path forward. Right now, Warsh is an unknown variable that markets are pricing with maximum uncertainty premium. By the end of July, that premium gets repriced. Variable 2. Nvidia will have reported its 2nd quarter, and the China question will have a real answer. Not a hopeful gesture from a Beijing visit, not an ambiguous remark on an earnings call, a real number with real shipment volumes against the backdrop of whatever the Trump-C summit produced. If the H200 channel opens with material volume, the AI bull case extends and Warsh loses his intellectual justification for cuts. If the H200 channel stays at 0 and Cooper's allegations about Singapore and Malaysia gain traction, the AI bull case starts unwinding, and Warsh suddenly has both the cover and the necessity to cut. Either outcome resolves the variable. Both are tradable. Variable 3. The trajectory of oil. Brent above $110 is the single largest contributor to current inflation pressure. If the Iran conflict de-escalates and the Strait of Hormuz reopens, even partially, oil retraces to the $80 range, and inflation prints fall sharply within 2 to 3 months. That opens the rate cut window naturally, without Warsh having to invent an intellectual justification for it. If the conflict escalates and oil pushes toward 120 or higher, the cut window stays closed indefinitely, but gold's safe haven bid intensifies. By the end of the 3rd quarter, the geopolitical fog clears enough to commit to one of these paths. When the 3 variables resolve in the same general direction at the same moment, gold moves. The direction depends on which path has converged, but the move itself is structural. The pattern is consistent across every major monetary regime transition of the last 40 years. Markets do not fear bad outcomes. They fear unresolved outcomes. The clearing of 3 simultaneous unknowns, regardless of which way they clear, is the catalyst. The cleanest scenario for gold bulls, the one where every variable cooperates, looks like this. Oil retraces to the 80s. Inflation prints come in soft for 2 consecutive months. Nvidia's guidance is mediocre. Warsh delivers a controlled rate cut at the September meeting with 3 or 4 dissenters voting against him. The bond market reads this as a chairman who is being pushed by political pressure. The long end of the curve sells off, the dollar weakens, and gold breaks to new highs as the real yield collapses. The cleanest scenario for gold bears looks like this. Oil holds above 110. Inflation reaccelerates. Nvidia posts a blowout China re-entry quarter. The AI capex cycle extends. Warsh holds rates and quietly initiates balance sheet reduction in October. The dollar strengthens significantly. The curve flattens further, and gold corrects another 15 to 20% before finding a structural floor at the level, though central banks are still buying. Even in this scenario, gold's downside is bounded by the steady accumulation by central banks in China, India, Turkey, and Russia. That bid does not depend on Western interest rate policy. The probability-weighted path is somewhere between those two scenarios, with what I would call a fat right tail. The reason it is fat, meaning the upside scenario has more probability mass than a normal distribution would assign, is that Warsh's position is structurally fragile. He needs too many things to go right simultaneously to deliver the regime change he wants. The base case is that he is forced into improvisation, and improvisation under political pressure historically resolves into easier policy than the chairman intended. There is one more variable that almost no one is discussing, and it deserves separate attention because if it moves everything else. The Federal Reserve's official inflation target uses core PCE, the Personal Consumption Expenditures Index excluding food and energy. That measure is currently running at 3% or slightly above. By that yardstick, the Fed is meaningfully above its 2% target and has no statistical justification for cutting rates. There is, however, a second inflation measure that the Federal Reserve Bank of Dallas calculates, called Trimmed Mean PCE. It removes the most extreme price increases and the most extreme price decreases each month, on the theory that the middle of the distribution gives you a cleaner read on underlying inflation momentum. That measure is currently running closer to 2.3%, within striking distance of the 2% target. A small but growing circle of macro analysts has noted that Warsh, in his academic writing during his Hoover Institution years, expressed preference for trimmed mean approaches over standard core measures. The argument is that core PCE excludes food and energy as a fixed rule, but in an inflationary environment driven by an oil shock, that exclusion is doing exactly the wrong thing, stripping out the volatility that actually contains the signal. If Warsh, at some point in his first year, formally shifts the Federal Reserve's preferred inflation gauge, or even informally weights trimmed mean more heavily in his public communication, the entire policy timeline compresses. Inflation does not have to fall to 2% for the Fed to start cutting. The Fed simply has to redefine which 2% it cares about. This sounds like a technical adjustment. It is not. It is a regime change disguised as a methodological footnote. Change the ruler and everyone's height changes. Change the inflation index and the entire calendar for the next cycle of monetary policy moves forward by 6 to 9 months. Most market participants are not modeling this possibility. The few who are positioning for it quietly. So what do you actually watch over the next 6 months? 5 signals, ranked by importance. The first and most important is Druckenmiller's next 13F, which will publish in mid-August, reflecting his second quarter holdings. The May 15th filing already showed him exiting Alphabet entirely, cutting Amazon by 99%, and opening a new position in Broadcom. The Alphabet and Amazon exits are signals about the AI trade, specifically, that he believes the most crowded names have run too far. The Broadcom entry is a signal about where the secondary infrastructure beneficiaries are. What I am watching for in the August filing is whether he adds gold mining equities, gold ETFs, or commodity exposure. If those positions appear, they are the single strongest signal the market will receive about where this configuration ends up. The second signal is Nvidia's second quarter earnings, which will land in late August. The headline numbers will not matter. The China detail will matter. Specifically, how many H200 units shipped to Chinese buyers against what revenue with what U.S. government revenue share applied? If the answer is meaningful volume, the AI narrative extends and Warsh's hands are tied for longer. If the answer is single-digit shipments or zero, the AI deflationary thesis loses its anchor and the path to rate cuts opens earlier. The third signal is the trajectory of Brent crude relative to the $80 level. Above 100, Warsh has no maneuvering room. Below 90, the inflation backdrop transforms within a single quarter. The Strait of Hormuz status is the most important headline most retail investors are not following daily. The fourth signal is the date Powell finally departs the Board of Governors. The market consensus is somewhere between August and October. The day he leaves, two things happen. Trump loses his preferred attack target, and Trump gains the ability to nominate a replacement governor. That replacement nominee will tell the market everything about which faction within the administration is winning the argument about Fed direction. If Trump nominates another Stephen Moran, the rate cut pressure intensifies. If he nominates someone aligned with the Warsh-Bessent regime change agenda, the picture clarifies in a very different direction. The fifth signal is the language Warsh uses in his post-meeting press conferences, assuming he keeps them, which he has signaled he may not. Watch specifically for the phrases trimmed mean balance sheet normalization and any reference to AI productivity in the context of policy decisions. The vocabulary shift is the leading indicator. The policy shift is the lagging one. 3 men, 1 philosophy, 2 chairs. Stanley Druckenmiller does not need to hold an office because the people who hold the offices that matter were trained, mentored, recruited, and shaped by him. Scott Bessent at Treasury, Kevin Warsh at the Federal Reserve. Both men formed in the same intellectual furnace, the conviction that the post-2008 monetary regime was a slow-motion catastrophe, that fiscal discipline is the prerequisite to economic health, that the printing press is the enemy of the working class, that Paul Volcker was the last honest central banker in American history. For 15 years, gold's price has been written by a Federal Reserve that was willing, under pressure, to print. That regime is now being dismantled by 2 men who have spent their entire adult lives believing it should never have existed. They will not succeed in fully unwinding it. The political and structural forces against them are too large, but they will reshape it. They will alter its trajectory. And in monetary history, even a marginal change in trajectory, sustained over 5 to 10 years, is the difference between an asset that compounds and an asset that decays. The story for gold in the second half of 2026 is not going to be a straight line. It will be a setup and a release. The setup is the holding pattern between now and the third quarter, while Warsh establishes credibility, while the AI question resolves, while the Iran conflict finds a level. The release is whatever comes after, and the magnitude of the release will be proportional to the duration of the setup. Long compressions produce sharp expansions. That is how markets metabolize uncertainty. Most retail investors will spend the next 6 months reacting to headlines. The May 20th NVIDIA print, the June FOMC, the next CPI release, the next Trump post about Powell. Each headline will produce a 5% swing in gold in either direction, and each swing will feel meaningful. Almost none of them will be. The signal is in the slower-moving variables I have just walked through. The headlines are the noise the signal hides inside. The question I am asked most often is whether to buy gold now, sell gold now, or wait. I do not answer that question because it is the wrong question. The right question is whether you understand the configuration of forces that will determine the price over the next 12 months. If you understand the configuration, your entry and exit decisions become technical problems. If you do not understand the configuration, no entry point is good enough to protect you from the next surprise. What I have given you in this video is the configuration. 3 men, 1 philosophy, 2 chairs, a 13F filed on May 15th that the financial press underreported, a confirmation vote on May 13th that history will mark as the inflection point, an inherited inflation problem that has no clean solution, an AI narrative that is starting to show stress fractures, a predecessor who declined to leave the building, and in the background, the quiet portfolio repositioning of a hedge fund manager who has been right about more macro turning points than almost any individual investor of the last 40 years. The pieces are on the board. The game has started. Whether you choose to play and on which side is a question only you can answer. This video is for educational and entertainment purposes only and does not constitute investment advice. Markets carry risk. All decisions should be based on your own financial situation and risk tolerance,